They told you it was a pet rock. They told you it was a relic of the past, a dead asset destined to collect dust while the digital world zoomed by. For years, the financial elite laughed at anyone accumulating physical metal instead of chasing the latest tech bubble. But today, the laughter has stopped. Silence has fallen over the trading floors of New York and London. We are witnessing a market event that defies the calculated predictions of every mainstream analyst. The price of silver hasn't just broken out, it is completely detached from reality as we knew it. We are staring at a spot price of $94. Let that number sink in. $94. Less than 3 weeks ago, we were sitting at 71. In a span of 19 days, silver has climbed 31%. If you annualize that return, the mathematics break the calculator. This is no longer a bull market. This is a currency collapse disguised as a price rally. We are currently outperforming Bitcoin, the S&P 500, and the entire tech sector combined. The most boring, suppressed asset on the periodic table has suddenly become the most dangerous trade on Wall Street. The mainstream media is scrambling to explain it, blaming speculative flows, but they are missing the forest for the trees. When a global commodity rises 30% in under a month, that isn't speculation. That is panic. That is capital realizing the building is on fire and trying to squeeze through a doggy door marked real assets. The move to $94 confirms a terrifying reality. The tariff traps are springing shut and the London vaults are effectively cut off from American markets. We are seeing sovereign default in slow motion at the mints, forcing billions of retail dollars into the spot market. But look closer at the chart. The move from 90 to 94 happened in a single session. This is the signature of a market with zero sellers. The miners aren't selling, they're holding out for triple digits or bypassing the open market entirely to sell directly to industrial giants. The banks have capitulated and are frantically trying to cover shorts. When you have vertical demand meeting non-existent supply, the price discovery mechanism breaks. We are watching the re-rating of silver from an industrial widget to a monetary reserve asset in real time. However, amidst this euphoria, there is a trap being laid. When you see your net worth jump 30% in a month, the biological reaction is greed. You start doing the math on a yacht. You start thinking about leverage. This is exactly what the institutional predators are waiting for. A vertical market is a fragile market. The higher the price goes on paper, the easier it is for the bullion banks to engineer a rug pull. We have seen this movie before. The path to triple digits is not a straight line. It is a minefield designed to strip you of your position right before the real move happens. But this time, there is a variable that the banks didn't account for. A new whale has entered the ocean, one with deeper pockets than the Federal Reserve and a desperation that outweighs any financial logic. We need to talk about the artificial intelligence demand shock. While everyone was watching solar panels and electric vehicles, a third engine quietly came online, and it is hungrier than the first two combined. You cannot have an AI revolution without a silver squeeze. It is a physical impossibility. When you ask a computer to think like a human, you need zero latency. You need electrical signals to move at the speed of light without resistance. There is only one element in the known universe that conducts electricity efficiently enough to prevent these massive supercomputers from melting down. It isn't copper, it isn't gold, it is silver. Silver is the coolant of the digital age. Microsoft, Google, and Amazon are currently building data centers that act as silver black holes. Every server, every switch, every semiconductor package requires silver. Wall Street analysts are still calculating demand based on jewelry and silverware, completely ignoring that the cloud is lined with silver. These tech giants are price insensitive. If Microsoft is building a $10 billion AI hub, they do not care if silver is $90 or $500. The cost of the metal is a rounding error, but the metal itself is non-negotiable. Without it, the facility doesn't work. This creates perfectly inelastic demand. They will pay any price to secure the physical metal, bypassing the paper markets entirely. This is why the COMEX vaults are draining even as the price skyrockets. The metal isn't going to investors. It is being locked away in the strategic reserves of Silicon Valley, removed from circulation for 20 years. When you combine solar consuming 20% of supply, EVs taking another 15%, and now AI entering the chat to devour the rest, you are left with a mathematical impossibility. There is simply not enough silver above ground to satisfy the industrial hunger and the monetary panic simultaneously. We are entering the phase of industrial desperation, but we must temper this excitement with a cold dose of history. The banks are wounded animals, and a wounded animal is most dangerous when it is cornered. We must analyze the history of violence in this market. Look at the charts from late December and early January. Every time silver broke a new record, the empire struck back. We saw 16% crashes in a single session, We saw 12% drops designed to flush out the leverage. This is algorithmic warfare. The banks can see your stop losses. They know exactly where the pain point is. If you leverage up at $94 thinking it's a guaranteed ride to 100, you are walking into a kill zone. They will use volatility to shake you out. They will drive the price down $10 in an hour just to trigger a cascade of margin calls, only to buy it back cheaper. If you are holding paper contracts, you are vulnerable. If you are holding physical metal, you are immune. This is the critical distinction. The investor who held physical silver through the volatility of the last month is up massive gains. The investor who tried to trade the swings with leverage has been wiped out. The banks cannot hunt physical metal. It has no counterparty risk. It has no margin call. So what is the strategy as we approach the psychological barrier of $100? It is the physical manifesto. You must stop playing their game. Do not sell your silver for dollars. Why would you trade a scarce, appreciating asset for a currency that is actively dying? Selling silver for fiat right now is like trading a lifeboat for a ticket back onto the Titanic. The dollar is not the destination. The dollar is the victim. The goal is not to have more cash. The goal is to have more purchasing power. We operate on the ounces to acres strategy. You hold until you can swap your metal for cash-flowing hard assets, land, real estate, a business. In 1980, it took 800 ounces to buy a home. Today, even at $94, we aren't there yet. The ratio must compress further. We are waiting for the moment when the paper price becomes irrelevant because the physical shortage is absolute. Be prepared for cash settlements. If you hold an ETF or a futures contract, read the fine print. When the real squeeze happens, they will close your account, write you a check for the last traded price, and leave you holding fiat currency while the street price of actual silver doubles or triples. This is why possession is 9/10 of the law. The train is leaving the station at 94 miles per hour. The turbulence will be severe. The banks will try one last time to buck you off. But if you hold the line, if you understand that this is a structural shift in the global economy and not just a bubble, you will see the wealth transfer of a century. The era of cheap silver is dead. The melt-up has begun.